Hey guys, Max here, and yesterday was Monday. Markets opened again after being closed for the weekend, so we have a fair bit to talk about. Some new proposals from Biden, new tax plans and things like that. Tesla announcing another share split and exploding on that news, and a couple other things, so let's just get right into it. So the markets themselves, what actually happened? Well, they rose for the most part. Tech and mega cap stocks, especially the S&P 500 rose by 0.7% and the Nasdaq rose by 1.3%. Markets were volatile though. At first, stocks dropped on news of another Russian poisoning, but then they recovered. What actually happened there? Well, there were some early reports that a Russian oligarch called Abramovich and some Ukrainian negotiators suffered poisoning back in early March. They all of them got ill, their skin started to peel off or something. It's all a little bit weird, a little bit unsure of what to make of it right now, but it's not exactly surprising if it turns out that Putin did try to poison them. He has a long-standing history of assassinating people via poison. Anyway, markets got scared on this news. It was an escalation, or it would have been, but it happened over 3 weeks ago and the people didn't die and they seem to have recovered by now, so it seemed a little bit unimportant and so the market rally continued. Now, what was the other news for markets? Well, oil prices fell slightly. We will cover why in a moment, and that's good for markets, obviously. Still very high prices, worrying for every business in the world, but every time we see a fall in oil prices, that is good news for markets, the economy, asset prices, really everything. Other than that, why did markets rise? Well, it was probably just another case of general investor sentiment getting a little bit better, money being moved from risk-off assets into risk-on assets to try and profit off of that increase in investor sentiment. Now, in currencies, the US dollar did quite well, rising 1.5% against the yen and 0.7% against the pound. Why? Well, it's probably on news of Biden's budget, which concentrated on reducing the size of the deficit. In reality, though, the deficit is still huge. There's still a huge planned increase in military spending as a result of the Russian invasion of Ukraine. Now, the idea here is that as interest rates rise, monetary tightening occurs, things get worse, but less debt for the government is a good thing, and this might see the US government have less debt. But let's be perfectly honest, the effect that this minuscule change in the deficit will have is practically nil, but either way, the US dollar rose on that news. Now, the ruble rose a little bit against the dollar again as some gaps in sanctions are starting to show now, and momentum from the West and from NATO as well has seriously started to slow down regarding these sanctions. The reality is many Russian banks are just not cut off from SWIFT. There is no real oil or gas embargo. There has been loads of talk from the West about standing up to Russia. There is still loads of strong words regarding military support to Ukraine and material support as well. But when it comes to things that will hurt themselves as well, European countries, like more expensive natural gas or oil prices as a result of sanctions, the West seems just unwilling to go the extra mile, and this is starting to reveal itself more and more, so the ruble is doing a little bit better. I would encourage people not to get too carried away there though, because the ruble is still down 40% from where it was during the invasion. That means that every Russian citizen right now is 40% poorer than they were just over a month ago. Now, there's also news the other week that Russia demanded natural gas payments to be made in ruble, and that has now officially been refused by every single member of the G7, as I thought would happen. Russia has now reiterated that demand once more. The West has maintained that they will not abide by it. There is no real news there again. Now, some people, of course, thought this was some genius 4D chess move by Putin. It will probably, though, have no major effect at all, really. Now, bond yields saw another crazy day once more. The US 10-year Treasury yield rose to 2.47%, another new 3-year high, which was really shocking. But by market close, it fell just slightly, so the yield is now sitting at 2.45%. There are still more outflows from bonds as the risk and monetary environment changes drastically. We should expect more volatility in the bond market for the next few months without a doubt, and then over the long term, the trend of yields rising in general should continue as well for years. Now, with oil, what happened? Well, prices fell quite a lot actually, which was really nice to see, and hopefully they will keep going lower, but that is a little bit unlikely in my opinion. WTI crude oil is down almost 10% now, sitting at $103 a barrel. Brent crude oil is down a little bit as well, sitting at $110 per barrel. Now, why did we see this fall in oil prices? Well, it was nothing to do with Ukraine or Russia for once, but this time about China. Now, in short, COVID is getting really bad in China again. The vaccines that they gave to everyone over there, the Sinovac ones made and designed in China, just don't work against the new variants, and they hardly even worked against the original virus either. So cases are skyrocketing. We are seeing mass COVID camps being used once again. There is loads of footage of them online, and they aren't actually quarantine camps at all. There is no separation between individuals, just huge rooms with 1,000 beds on the floor and 1,000 sick people in them all crammed together. Shanghai has now locked down 20 million people. Many other cities have done similar stuff recently as well. Really, this is just bad news for China's economy as a whole, and that's worrying for their demand for oil too. China is the world's largest importer of oil, and as lockdowns take hold, as the economy slows down, oil imports will reduce, and that will reduce buying pressure and cause prices to fall, which is very welcome across the rest of the world. Now, this fall in price of oil that we just saw is in anticipation of this happening. It hasn't actually happened yet. China's demand hasn't fallen yet, but we all think it will, and we all know how speculators control markets these days, so this fall in price isn't surprising. Now, gold prices fell a fair bit too, almost 2%, down to about $1,920 an ounce, still just above that $1,900 mark now, where there seems to be lots of support from buyers. Gold was stuck at around $1,800 for months, and it looks like now we'll probably be stuck at around $1,900 for a bit. Now finally, for the markets today, what happened in the world of crypto? Well, there were big gains for many different coins. Last week, Bitcoin was sitting at about $44,000 and Ethereum at about $3,000. Right now, though, both of them are up around 10% from then. Bitcoin's now sitting at $47,500 and Ethereum at $3,400. There is quite a strong bull run in crypto right now, and there's no real reason for it though, just a general increase in investor sentiment, confidence about markets not being shaken by the Ukraine war anymore, things like that. Altcoins saw that same sort of thing, big gains across the board, 10%, some 15%, and of course some rising less than that too. Now, there was some big news for yesterday, which was Tesla announcing a share split that probably shouldn't actually be too surprising. We know this is the sort of thing Tesla and Elon like to do. They've done it in the past, and it helps to drive hype for the stock and reduce the barrier to entry. Now, the actual legitimate reason for a share split leading to a share price increase is basically the idea that when a share gets a bit too expensive, and Tesla has been as high as $1,200 per share, let's not forget, some people are forced to not buy the stock because they can't afford one full share. By cutting that price down, many more people can afford to buy that stock, and buying pressure should increase. Now, the best example of a stock getting too expensive to be a barrier to entry is Berkshire Hathaway's Class A stock, which currently trades at about $540,000 each. Now, the reason it's so high is very simple. Buffett doesn't want small-time investors who jump in and out of positions easily buying Class A shares, as it has better voting rights and a couple other privileges. Now, as for Tesla, $1,000 a share is restrictive, but not by too much, to be honest, thanks to the prevalence of fractional shares offered by most firms these days. Tesla investors especially are just far more likely to use a brokerage that offers fractional shares, something like Robinhood, so this change shouldn't actually have any real impact on Tesla's price in the long term. But of course, Tesla being Tesla, it has its own rules of nature, and so the share price exploded. The company is now worth $84 billion more than before it announced this share split, as investors piled into the company. That's more than the entire value of Ford or GM in a single day on news that actually in the long term does not matter at all. Now, are we surprised this happened though? Not really. It's Tesla, it's always been a bit crazy, and 8% increase in price in one day isn't unheard of for the stock either. Now, some people are saying that in the past, a share split led to a 700% increase in the share price of the company, which is why they're buying now, but that doesn't really have any relevance to what Tesla will do in the future. What we're seeing here is just a pure psychological move by Tesla to entice more investors in. It's adding some excitement to the company again, getting everyone talking about it again, and persuading some to buy its shares. Elon and Tesla are both really good at this sort of thing, of basically advertising the stock without calling it an advert, on playing on people's psychology and gaining some positive press. Now, should a stock this large be moving by this much? No, of course not, but this is the result of quantitative easing, helicopter money, huge government deficits for years on end, and just loose monetary policy in general. Now, in the UK, the energy shock is scaring a lot of people even further, with GDP forecasts for the country being cut right down from 6% to just under 4% as a result of this increase in oil and gas prices. Now, this is coming from the OBS as well, which shouldn't be biased about this, even though they are often wrong, let's not forget. The scary thing they said though was that if it weren't for the bounce back effect of the lockdowns ending and people spending extra money basically to make up for what we didn't spend over the last 2 years during lockdowns, if it weren't for that effect, this oil and gas price shock would send us into a recession this year. Now this is probably true, but that doesn't mean that we aren't going to enter a recession anyway. It just might not come until 2023, as we still have the strong growth of the first quarter and recessions just take time to lag. Now this is actually a very pragmatic thing to come out from what basically amounts to the British government. You won't hear anything like this coming out from something funded by the Federal Reserve, for instance, even though the realities behind our situations are very similar for both countries here. Now that is for sure something to think about and something to pay attention to in the future as well. Now, in random news, Charlie Munger, the sidekick to Warren Buffett, is stepping back from some work and giving up his chairman title of the Daily Journal. He is 98 years old, so not exactly retiring early, let's be honest, but we will miss his insights at the Daily Journal's annual meetings, as it's always been interesting to hear what he has to say, and he probably won't be at those anymore. I hope he still is, but he probably won't be. This does make sense though. He's very old. He and Buffett even look very old as well, and they aren't going to live forever. That much is true. Hopefully they can make it to the end of this bubble so they can get to scoop up some companies on the cheap, but there's no guarantee in that, of course. Now, lastly, later this week, we will get a bunch of new data and reports on a bunch of different things. US GDP figures, US job reports, China manufacturing data. Australia is putting out their budget today. A couple Fed presidents are going to speak as well. So lots to look forward to, and this could be a very interesting week. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio, and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up, so if that sounds interesting, if you want to protect your portfolio against inflation, then make sure to check it out. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you get from any savings account these days. Just make sure not to use Tether. Thanks for watching, stay stoic. Until next time.